March of 2023, a bank with over $200 billion in assets collapsed in less than 48 hours. Not over months, not over years. 2 days. It was the 16th largest bank in the United States. It had survived for almost 40 years. And then, in the span of a single business week, it was gone. Seized by federal regulators, its depositors scrambling to find out if their money still existed. This is the story of Silicon Valley Bank. And once you understand exactly what happened, you'll understand something most people never learn. That a bank can be profitable, well run on paper, and still collapse in days because of one mechanic hiding inside every single bank on earth, including yours. To understand the collapse, you first need to understand what made this bank different. Silicon Valley Bank wasn't your typical neighborhood bank. It served startups, venture capital firms, tech companies flush with investor cash. If you were a startup in the 2000s or early 2020s, there was a good chance your company's money lived at SVB, and starting around 2020, an enormous amount of money flowed into SVB. Tech was booming, venture capital was pouring billions into startups. Those startups parked that cash at SVB and SVB's deposits exploded. Here's the problem. A bank can't just let deposits sit there doing nothing. As we covered in our last video, banks make money by putting deposits to work. Loans are the obvious choice, but SVB had a different one. Instead of mostly issuing loans, SVB took a huge portion of those deposits and bought long-term US government bonds. This wasn't reckless. Government bonds are considered one of the safest investments in the world. The US government has never defaulted on one. But there was a catch. And the catch is the entire reason this story exists. When you buy a long-term bond, you're locking in an interest rate for years, sometimes a decade or more. SVB bought billions of dollars of these bonds when interest rates were near historic lows. Then, starting in 2022, the Federal Reserve did something dramatic. It started raising interest rates at the fastest pace in over 40 years, trying to fight inflation. And here's the mechanic almost nobody outside of banking understands. When interest rates rise, the value of existing bonds falls. Because why would anyone pay full price for SVB's old bonds paying 1.5% interest when brand new bonds were now paying 4 or 5%? SVB's bond portfolio, tens of billions of dollars of it, was suddenly worth significantly less than what they paid for it, on paper. And on paper is the key phrase. As long as SVB didn't have to sell those bonds, the loss didn't matter. They could just hold them until they matured and get their full money back eventually. This is called an unrealized loss, a loss that only becomes real the moment you actually sell. SVB was fine as long as nobody asked for their money back all at once. By 2022, the tech boom was cooling off. Venture capital funding slowed dramatically. Startups that once had cash to spare were now burning through their reserves just to make payroll, so they did the obvious thing. They started withdrawing their deposits from SVB faster than new money was coming in. This put SVB in a bind. Remember, most of that deposit money wasn't sitting in a vault. A huge chunk of it was tied up in those long-term bonds that had lost value on paper. To cover the withdrawals, SVB had only one real option: sell some of those bonds immediately, which meant the unrealized loss became very real. On March 8, 2023, SVB sold roughly $21 billion of its bonds and announced it had taken an actual loss of about $1.8 billion on that sale. To cover the gap, they also announced they'd need to raise more than $2 billion in new capital. This is the moment everything changed. Not because the loss itself was fatal, but because of what it signaled. Word spread fast. A major ratings agency downgraded SVB's outlook that same evening. Prominent venture capital firms, the same firms whose startups banked with SVB, began quietly telling their portfolio companies one thing: get your money out. And this is where the mechanic from our last video becomes terrifying instead of theoretical. Remember, a bank only keeps a fraction of deposits available at any given moment. The rest is out working in loans, in this case in bonds. When word spreads that a bank might be in trouble, depositors don't wait around to find out. They withdraw. All of them. All at once. This is a bank run, and in 2023, it didn't happen through lines outside a building, it happened through phones. On March 9th alone, depositors tried to pull out an estimated $42 billion from SVB in a single day. That's not a typo, that's roughly a quarter of the bank's entire deposit base, gone in about 6 hours, in large part because digital banking made a bank run happen at the speed of a text message instead of the speed of a line down the block. SVB simply didn't have that much cash. Nobody would. No bank in the world holds 100% of deposits in liquid cash. That's not how banking works, as we've already covered. By the morning of March 10th, regulators stepped in. The FDIC seized Silicon Valley Bank and shut it down. A bank that had operated for nearly 40 years, that was profitable as recently as its last earnings report, was gone in under 48 hours. So what happens to your money when your bank collapses? This is where the safeguards from our last video get tested in real time. Normally, the FDIC guarantees deposits up to $250,000 per depositor. But SVB's customers weren't typical retail depositors. They were startups and companies, often holding millions in a single account, almost all of it far above that insured limit. If the standard rule had applied, thousands of companies could have lost access to the vast majority of their operating cash overnight, enough to miss payroll, potentially triggering a wave of secondary business failures. Regulators decided that risk was too dangerous to the broader financial system. So the Treasury Department, the Federal Reserve, and the FDIC took an extraordinary step. They invoked something called the systemic risk exception and announced that all depositors at SVB, insured or not, would be made whole. Every dollar. Importantly, this wasn't a bailout of the bank itself. SVB's shareholders and executives lost their investment entirely. This was a guarantee for depositors, the startups and companies who had done nothing wrong except keep their operating cash at the wrong bank. The Fed also rolled out a new emergency lending program that same weekend, allowing other banks facing similar bond losses to borrow cash using those devalued bonds as collateral valued at their original price, not their crashed market price. The goal? Stop the panic from spreading to other banks holding similar long-term bonds. It mostly worked. A few other banks failed in the following weeks, but the broader banking system stabilized. Depositors got their money, and SVB's remaining assets were eventually sold off to another bank. So why does a tech industry bank collapse from 2023 matter to you if you don't run a startup? Because SVB didn't fail from doing something reckless or fraudulent. It failed from a mechanic that exists inside every bank, taking deposits and putting the majority of them to work somewhere else. That's not a flaw, it's the system. Exactly like we explained in our last video. SVB just got the timing catastrophically wrong. This is also why interest rate changes from the Fed aren't just abstract headlines. When rates move fast, banks holding long-term bonds or loans issued at old rates can find themselves sitting on losses they never expected, the exact mechanic that started this entire collapse. And this is why modern bank runs move faster and more dangerously than they used to. In the 1930s, a bank run meant physical lines outside a building panic that spread at walking pace. In 2023, $42 billion left a bank in a single day, spread by group chats and Twitter threads. The mechanic hasn't changed since the Goldsmiths. The speed has. For everyday depositors, the real takeaway isn't fear, it's this. FDIC insurance up to $250,000 per depositor per bank is the exact safeguard built after the Great Depression specifically to prevent what almost happened to SVB's customers from happening to you. If your deposits are within that limit, this entire chain of events is largely irrelevant to your money's safety. But if you ever find yourself running a business or holding a large balance at a single bank, SVB is the reason financial advisors tell you to think about where and how you keep large sums of cash. So the next time you hear about a bank collapsing, remember, it's rarely about a bank doing something illegal. It's almost always the same mechanic we've covered from the very beginning: deposits, reserves, and lending meeting a moment where too many people want their money back too fast all at once. The system survived 2023, but it survived because of safeguards built decades earlier, specifically for moments like this one. And that raises the next question worth asking. If the Fed can step in and guarantee billions overnight, where does that money actually come from? That's next.